Well, hey, Darren, welcome to the Saving Yourself from Wall Street show. I really appreciate your time.
Kurt, it's a pleasure to be here. Thank you for having me on.
Yeah, you guys have a great story to tell, and I think it kind of aligns with what we're trying to do at Saving Yourself from Wall Street. So there's already a pretty crowded ETF market. So why did you all? What's sort of your mission or your calling with Asym?
So we wanted to be the anti-Wall Street firm with asymmetric ETFs and do our small part to level the investment playing field, because we looked around, and my background is an institutional hedge fund manager. And so sovereign wealth funds, family offices, ERISA plans, they've had access to funds that produce asymmetric returns, hence our name, for decades. And by having access to these type of strategies that are uncorrelated to the broader markets, have a focus on capital preservation, but still producing market-like returns, it's played its part to lead to wealth inequality. And so now looking at the marketplace today with interest rates near record lows, equities near record highs, where are advisors, where are retail investors to turn to something that doesn't increase the risk in their portfolio but mitigates it? And that's where asymmetric ETFs comes in, and that's our vision. We want to empower the little guy. And Kurt, one quick analogy here. I love it because it's so true. It's like Uber, through technology, brought black car service to the masses and revolutionized the way people commute. Asymmetric ETFs, through technology, is bringing the benefits of hedge funds, which are asymmetric returns, to Main Street, and should revolutionize the way retail investors and advisors manage their portfolios.
Okay, awesome. Well, I mean, since you've already alluded to it, so what can you give us sort of an overview of asymmetrical ETFs and kind of sort of how they function and where you see them fitting in the whole landscape for an investor?
Sure. So when I look at asymmetric ETFs is where they fit into a portfolio. I'm going to pull up a couple of screens here just to kind of help our conversation along. Number one, they are designed to optimize a portfolio. Okay, so when we talk about optimization, what do we mean by that? And that is, optimization is lowering the risk and improving the performance. Correct? That's modern portfolio theory,
Yeah,
correct? You look for uncorrelated assets that you want to bring together into a portfolio, so that by bringing these different assets that zig and zag at different times, what you do is you reduce overall portfolio risk and you improve overall portfolio performance. But the key is you need assets that are uncorrelated to each other. And so what we found when you look back in the market, 08, 09, 00 to 02, that risk assets became highly correlated to each other. The common comment was the correlation became 1, which means it moves exactly like the market. Now, not all assets became 1 in correlation, but what they did do, all equities went down. Now, and they went down in tandem with the market. Whether they dropped as much as the market or not, they went down. And so if you have that from a diversification standpoint, that's terrible, right? There's no diversification in your portfolio. It's a false sense of security. So ASPI comes in and fills that gap. ASPI was created, which is our initial fund, the asymmetric version of the S&P 500, to zig when the market zags. So when the market drops off, ASPI was engineered to actually produce positive returns in bear markets when you need it most. So the rest of your portfolio is dropping, and if ASPI is doing its job and doing what it was designed to do, it should be going up in value, which is that's a negative correlation, in fact, but that's what uncorrelated returns do. And that's historically what bonds used to do, a role they played in the portfolio, that buffer effect in down markets.
Well, so, I mean, obviously just what you're talking about there is going to entice a lot of folks. So like, how does it actually function?
Okay.
Getting a little into the weeds. So, I mean, if you're an investor, if I don't know anything about asymmetric ETFs and I hear, okay, I'm going to get upside of the market, but I also have a negative correlation to it when I need it the most. So how does that happen?
Sure. Well, we don't use derivatives. That's really important to us because derivatives are too complex.
Okay.
And an old Wall Street adage, again, being the anti-Wall Street firm, we want to share a lot of Wall Street's secrets and make them public. An old Wall Street adage is, if you don't understand an investment, don't invest. right? Number one, because the probability of losing money just increases exponentially. Sure. So with derivatives, most retail investors certainly don't understand the risks that are inherent by options-based strategy. So ours is not an option-based strategy. So at its core is this slide. It's driven by asymmetric risk management technology. A little backstory on the technology is asymmetric risk management technology comes from an institutional mandate. It was behind one of the largest hedge fund seeds of 2015. It was a $250 million hedge fund seed based on this technology. And what we've done is brought it in its pure form down to Main Street. So that's why I say we're bringing institutional solutions to Main Street. The technology right here, here's your overview. It's two price-based signals. Okay, price-based, and we can talk about that more in detail, but two price-based signals are designed to accurately measure the current market risk environment, and it buckets it into three risk environments: risk off being a bear market, risk on being a bull market, and risk elevated is an uncertain market. So two price-based signals are designed to accurately measure market risk. And when you have that, then how do we position the portfolio to profit from either a bull or bear market? By systematically changing net exposure. So you can see that here on the right-hand side of this slide, you're getting into your portfolio exposure. So price-based signals accurately identify market risk. When we know what market risk looks like, then we systematically, or the technology systematically changes net exposure. In a bull market, we're net long. We would expect to capture 75% of the upside, in this case, of the S&P 500. In a bear market, we go net short. And by being net short, we'd expect to capture, on a negative basis, 25% of whatever the market loses. So if the market loses 50%, like the S&P 500 did in 00 to 02, and again in 08 and 09, then we'd expect the portfolio to be up 12.5% in that environment. So with asymmetric ETFs and ACE by our first fund, you have the prospect of always being invested, but your money, again, is positioned to always profit regardless of market environments. And this is how the technology works.
And you kind of mentioned there's two price inputs that you use. A lot of people just that are trying to mitigate with a purely negative correlated, they look at the VIX, so the volatility index. So how does your price inputs kind of differ from the commonly known VIX index?
Well, I'm glad you asked that question, because our second input is looking at volatility. And so it's called our price volatility indicator. It's a proprietary measure of volatility. So as most people will know, VIX measures implied volatility. And it is looking at a select group of institutional investors that are trading options based on the market, and in this case, again, the S&P 500, and it looks at the difference between vol from one contract to the next, and that's how it prices implied volatility. And so it's smart money, a small segment of the market. It's smart money. Smart money is not always right, and so smart money can be a misnomer. What we look at is price vol. And the reason we had to create a new measure of volatility was the original application for asymmetric risk management technology was actually in a U.S. energy infrastructure application. So had we used VIX to measure risk in an energy-related sector, we would have had a mismatch. We would have been measuring risk in one market and then managing risk in another. And that's a terrible solution, right? And then it becomes random. So we created price vol, which, again, price. We're looking at the price movements of the underlying securities that comprise the index or the market where we're managing risk, in this case, the S&P 500. So price vol looks at the price movements of all of the securities of the S&P 500. And by doing that, what we're getting is a much more granular measure of market risk, because we're capturing all market participants. Anyone who's buying and selling a security in the S&P 500, we're capturing that in this measurement of volatility. And so it's a more granular measure of market risk, and we argue more accurate as well. Okay. So if you look at price vol here in this chart, what it needs to do from asymmetric risk management technology standpoint, it needs to spike when we're in bear markets, because that's a risk off signal for us. And look at this, 00 to 02. Price vol goes above its threshold here, which is the red line, and remains elevated pretty much the entirety of the dot-com bust. And again, the great housing crisis, or the Great Recession of 08, 09, again, price vol spikes. It even captured COVID last year. and spiked. And unlike VIX, this is my last comment on price vol versus VIX. VIX, if you looked at it, remained elevated from March 2020 through March of 2021, a whole year remained elevated. Well, if you're using VIX as a risk measurement or metric, you would have been on the wrong side of the trade because the market's ripped back after 2020, right? The smart money remained on the sideline thinking this isn't going to last, but new players came in, right? Meme stock investors, other things. More leverage was getting added to the market in terms of margin debt. So lots of buying. And our measure of risk, price vol, spiked. It was up. It was elevated in March, elevated in April, May. It was already back down. So it spiked for 2 months and compressed again, saying, hey, we're back into another bull market run from a volatility perspective. So a lot on price vol, but it's an amazing measurement for market volatility and risk.
Okay, so that's one of the price metrics, and then do you focus the other just on sort of moving averages, or how does that work?
Yes, so the second one is moving averages, and that's our price momentum indicator here. And again, what is it meant to do? Effectively identify market trends. And we're using the 200-day moving average as the primary driver of our price momentum indicator for a good reason. Asymmetric risk management technology, it's a rules-based strategy. It rebalances on a monthly basis. Okay. So we're trying to identify long-term market trends. And what we want to do is we want to be positioned net long in a bull market for the entirety of a bull market, and we don't want to get shaken in and out, rebalancing daily, rebalancing intra-month. We do that by looking at long-term averages. We want to be on the right side of a market movement, so it has characteristics of momentum investing. Okay. And profit from it. And then the flip side, when we move into a bear market, we don't want to get shaken up. We don't want to catch a falling knife. Oh, the market starts to go back up. It's a buying opportunity. We're going to be looking for the market again to establish long-term trends. So we're looking at the 200-day moving average, primarily drives our price momentum indicator. And does it work to identify bear markets? Look at this. 00 to 02, the market breaks down beneath the 200-day moving average and remains beneath it. 08, 09, again, the Great Recession breaks down and remains beneath it the entirety. That's a risk-off signal for us. So you look at our risk environments in the market breaks down technically, and you have a spike in volatility. Those two things only come together in a bear market. In a bear market, we're risk-off. When we're risk-off, we're net short. Market volatility spikes, market breaks down technically, vol spikes, okay, we're in a bear market. In a bear market, the technology says this is what our exposure looks like. And Kirk, look at this. There's two lines of defense here. The first line of defense is look at gross exposure. Right? Overall exposure just gets reduced. What's the most amount of money that you can lose anyone is what you have invested, right? At risk, capital at risk. So we reduce the amount of capital at risk. It's the same thing Goldman Sachs does. They tell their prop traders as market risk starts to rise, pull in your horns, lower your gross exposure, lower your net exposure. We're bringing that type of an institutional discipline to Main Street. So we lower our exposure. Number one, don't be a hero. So keep your capital intact so you can make money in the next bear market. Let the benefits of compounding work for you, right? Don't fight them by losing 50%. Let compounding, the most powerful tools that we have as investors, work in your favor. And then the second one is, okay, first, reduce the overall exposure. Don't lose a lot. Don't put a lot of capital at risk. And two, since we're going to be in a bear market, we had 1928 through 32, 4 down years, 00 to 02, 3 down years, almost 2 down years, 7 to 9. Investors still want their capital working for them. So when we've identified that we're in a bear market, the market's going down, let's be short. Right? Let's be short the market to profit from it versus most of our competitor strategies. They're just going on to the sideline in cash. They're providing first loss. That's great. Better than losing a lot of capital. That's our first goal. But the second goal isn't even better if you can make some money. And that's the way we do it, by not using derivatives, but by shorting the market. And then we go short the actual market.
Okay. So you're literally, since you're not using derivatives, you are shorting like just like an SPY, or how do you do that?
Yeah, that's exactly what we're doing here. As you can see, we're actually shorting SPY. Okay. We're shorting the actual market because it's difficult enough. Think of it. It's difficult enough to get the market risk environment right.
Sure.
So say we're in a bear market with a high degree of confidence. And if we get that signal right, well then you watch the flow. Okay, then we're going to reduce our exposure, go net short. You could still make a mistake. You could now, your algorithm could say, well, we're going to be short high beta stocks. Well, high beta stocks may or may not go down. But when you're short the market, and that's where you're managing risk. Well, if the market's going down and you're short it, your book's going to be going up in the opposite direction.
Okay. Yeah. So, as you look at whether you're talking to financial planners or just individual investors, how are most people kind of plugging, Asym in? Is it replacing their large cap exposure in a portfolio? Is it complementing the large cap? Are you pulling money from bonds into this since you have a downside protection? What do you typically find people are doing?
All of the above.
Okay. All right.
I mean, honestly, that's the answer. I mean, we were speaking yesterday with a $1 billion RIA, and at the end of it, the question was, well, so how will you use ASPI within your portfolios? And this individual that we're speaking to said, initially it will be a bond substitute because I'm looking at low interest rates right now, the prospect of rising inflation, interest rate risk in my bond portfolio. So I'm not making any money. I have principal at risk now in the portfolio. There's going to be a drag on performance. And I don't want to increase risk by moving into these other income producing equities that are going to correlate highly or potentially correlate highly with the market when it goes down. He said, this is a beautiful solution for me. I get the upside potential if the market continues to move up, the consistency of returns or the potential of the consistency of the returns. But when things really go bad, I'm getting that other characteristic of bonds that I don't believe we're going to have in the portfolio right now, which is the buffer effect,
Sure.
right? To mitigate the losses versus jumping into some of these equities, which are just going to give you equity-like risk across more of your portfolio, which means you're going to hurt your clients more in the next bear market. So we're seeing that is a really big trade right now that advisors are making. And then the second one is just looking at taking and locking in some of the gains in the portfolio, like where we believe ASPI belongs in the portfolio long term. It is a core equity holding.
Okay.
The fact that we're using hedging in it, look at the risk profile again. The maximum exposure is 100% net long. So we're never trying to goose returns by using our ability to hedge. We're using hedging only for one purpose, to mitigate returns. So if you look at the index that ASPI tracks, you can see the historical returns, low volatility, low correlation, low drawdown. That's what we're looking to do. If you have something in your portfolio that can consistently produce equity returns that's 7 to 9% across bear and bull markets, make that your core holding and then build around it. Build your satellite positions around that. So that's long-term where we see it fit in the portfolio.
Okay, great. So it'll be the core of like a core and explore strategy.
Sure.
Okay.
Yeah.
And you mentioned returns and correlation. Do you have data as far as how it's done in those areas relative to the S&P 500?
We sure do. So I'd love to pull it up in front of me right now. I can't do it. So let me just say where you can find it. It's asymsolutions.com, which is the index website. And so let me touch on a couple of factors that are really important when I look at risk in portfolios. Number one, asymmetric. The way we measure risk is absolute, on an absolute level. So we look at drawdowns. And when I say if you look at any manager or any strategy and you want to understand the risk profile, don't worry about standard deviation. It's another measure of risk. But look at drawdown, number one. Go, what's your maximum drawdown? Ask a manager that when you're considering a strategy. Look at an ETF. Say, what's the maximum drawdown on this ETF? You have a great idea of the type of risk that this financial product or solution is taking on by viewing risk on an absolute basis, looking at maximum drawdown. So historically, the index that again, ASPI tracks, the historical drawdown, maximum drawdown is 10%. You compare that to the S&P 500, it lost 55% in the great recession of 08-09, right? So very low drawdown. And then the second part, although the S&P 500 is the building block of the asymmetric version of the S&P 500. We take the S&P 500, we integrate asymmetric risk management technology into it, measuring the risk of the S&P 500. When we know what the risk of the S&P 500 looks like, we change our portfolio exposures to manage and mitigate that risk within the portfolio. So we take the S&P 500, integrate our technology, transform it to something completely new. And you look at the correlation, although ASPI comes from the S&P 500, historically its correlation is 0.33.
Wow.
So you start to get those type of correlations. I mean, those are uncorrelated asset class. That's bond-like correlation to equities. And so when you add that, that's why you say this ASPI, when you think of it, and our suite of asymmetric ETFs, this is the first. They're powerful portfolio optimization tools because of the low correlation, because of the low drawdown, because of the inverse correlation in bear markets. So there's so many different benefits baked in, but all behind that simple premise, the overview I showed you. 2 risk-based signals are designed to accurately identify market risk. When we know what market risk is, then we position the portfolio to profit from either a bull or a bear market.
Okay. And you brought up your website. I was going to talk about how you guys have a lot of information there for individual investors, including sort of where we're at right now on your price volatility metrics. So, I mean, you guys are really offering a lot of information. Can you give that information one more time, as well as if there's any, Twitter feed or Facebook page or some other place that people could find you?
Super. Absolutely. So we're big on transparency. If we're going to be the anti-Wall Street firm, we have to put our mouth, show, what is it? What the expression?
Put your money where the mouth is. Yeah.
Right. Put your money where your mouth is. Or I can't hear what you say because your actions speak too loud, right? So we have to show different. We have to be different. Sure. And part of being different is transparency. So if you look on asymshares.com, which is the ETF website, you go under ASPI, our initial website. At the end of every month, when we rebalance it, we let advisors and investors know exactly where we are. Here's the current risk environment of the market. Here's the way the portfolio is positioned from an exposure standpoint. Here's what our price momentum indicator shows. Here's what our price volatility indicator shows. So at a snapshot, you know right away how the portfolio is positioned. That's asymshares.com. We also publish a monthly report card. Okay. Are we doing what we said we would do? And we're not always going to be, right? Nothing's perfect, but we're accountable. We want you as an advisor to know and as a retail investor to know what's going on in your portfolio so you feel comfortable about why the decisions were made. So again, a ton of transparency into what we're doing. It's all published on our website, asymshares.com. And then the other place is Asym Solutions, which is our index website, which is where you'll get the historical results of the technology integrated into the S&P 500. So those are 2 great sites. LinkedIn, we're publishing information there on a consistent basis. We have a Twitter, which is Asymmetric ETFs, LinkedIn, Twitter, at Asym ETFs there. So you can find us a lot of places. We just actually opened up a YouTube channel. We're starting to produce educational and market videos as well. So again, it's Asymmetric ETFs, and then our website, everything will end up, getting posted there at some point as well. Okay. So,
and do you eventually see maybe also adding other ETFs that focus on other benchmarks outside just the S&P 500?
Absolutely. So the technology is extremely scalable. Okay. We have 40 different tickers reserved with the New York Stock Exchange right now.
Okay. Wow.
Yeah. To open a suite of asymmetric ETFs. We also have some really cool ideas on some income producing ideas. On advisors are looking for income right now. How can we help advisors to get income in a fashion that's safer? That's our objective, safer than what they're getting right now. Again, by having this downside protection. Okay. You clip the coupon when it's good, but when things and risk starts to rise, get out of that position and don't lose your principal. I've experienced that too much in income producing asset classes that it doesn't matter how much income you make if you lose 50% of your money.
Yeah, absolutely. That old Warren Buffett, right? Rule number 1, don't lose money. Rule number 2, refer to rule number 1.
Rule number 1. That's our philosophy, brother, at our core, right? Do not lose money. The path to wealth creation is capital preservation, and you're not hearing people say that today. It's all about alpha generation. Yep. Let's compare ourselves to the market. How did you do relative to the market? It's like, don't worry about that. What investors care about is, am I on target to have enough money to live off of when I enter retirement? And when I'm in retirement, do I have enough money that I'm not going to outlive my money or the purchasing power of my money? Who cares what the market does? Yeah. Right? You're your own market. What matters most is where you are relative to where you need to be at a certain point in time.
Absolutely. You're preaching. Yeah. Right. No, I agree. Well, Darren, so I'll put in the show notes all the places that they can find where you guys are at. And I really appreciate your time. I think what you're doing is much needed for folks, especially considering the market conditions right now. So really appreciate what you're doing.
Kirk, thank you for having me on. I hope there'll be an opportunity in the future to come back on and get caught up again and see how things are going.
Absolutely. Well, take care.
Thank you. You too.